Charts today because you get to a certain point when you read the underlying documentation that sometimes charts aren't even worth watching because you know the future outlook and what the Fed's plans are. Now this filing here is from the National Securities Clearing Corporation. It is a filing, and this actually came out today. They've determined that they're going to institute proceedings to determine whether or not to approve this rule, which is to adopt an intraday volatility charge and eliminate intraday backtesting charge. So this is going to be taken to proceedings to determine if it's going to be approved or not. That is a common practice in SEC law. It's a definite commonality when it comes to these filings. You oftentimes see these proceedings instituted, especially from filings out of the major SROs. Now what this filing does, first, in this filing, it's about 83 pages long. It gives you some background into the NSCC's clearing fund methodology. And this proposal basically is enhancing that methodology by implementing the intraday volatility charge that may be collected by NSCC to mitigate the risks presented by members' adjusted intraday, net unsettled positions, and net balance order unsettled positions, herein collectively referred to as net unsettled positions. And then you have a super note 2 there. This says net unsettled positions refer to net positions that have not yet passed their settlement date or did not settle on their settlement date. So anything that did not settle, or anything that has not reached its settlement date thus far, is considered a net unsettled position. And an overview real quick of the required fund deposit. They do give you a brief breakdown. As part of its risk management strategy, NSCC manages its credit exposure to members by determining the appropriate required fund deposits to the clearing fund and monitoring its sufficiency as provided for in the rules. The required fund deposit serves as each member's margin. So that's basically what it is. Whenever you hear the required fund deposit, think margin. The objective of this deposit is, to mitigate potential losses to NSCC associated with liquidating a member's portfolio in the event NSCC ceases to act for that member, which is referred to as a defaulting member. So whenever you take the aggregate, or you combine all of the members' deposits together, that equals the clearing fund of NSCC. So whenever you hear the clearing fund of NSCC, just think it's the members of the industry. It's their aggregate margin, basically, is what it is. Now, anyone in the group, this is what I was talking about with paper trading. It is absolutely essential, especially if you are new to options. You must paper trade. It's efficient, it's accurate, and it gives you insight into the options market. And if you don't think the industry does it, they do. NSCC employs daily backtesting to determine the adequacy of each member's required fund deposit. NSCC compares the required fund deposit for each member with the simulated liquidation gains and losses using the actual positions in the member's portfolio and actual historical security returns. NSCC investigates the causes of any backtesting deficiencies. So they're experimenting by doing simulations and testing experiments. That is exactly what all of us can be doing with paper trading. So basically, the volatility component of each member's required fund deposit is designed to measure market price volatility of the start of day portfolio and is calculated for members' net unsettled positions. The volatility component is designed to capture the market price risk associated with each member's portfolio at a 99th percentile level of confidence. This is what I was talking about yesterday in the group. 99 percentile. That is a very good number. Now, NSCC has two methodologies for calculating the volatility component. They have a VAR charge and a haircut-based calculation. The VAR charge applies to the majority of net unsettled positions as calculated at the greater of 1, the larger of 2 separate calculations that utilize a parametric value at risk model. Number 2, a gap risk measure calculation based on the concentration threshold of the largest non-index position in a portfolio. And 3, a portfolio margin floor calculation based on the market values of the long and short positions in the portfolio. The VAR charge usually comprises the largest portion of a member's required fund deposit. So of that deposit, the biggest part of it is the VAR charge, which is the value at risk charge. So I'm going to link this below. That's just some basic background into what the NSCC required fund deposit is, the intraday volatility backtesting charge. If you'd like to get more info on this, I will link this below. And again, reading filings is essential to understanding how the market operates from an underlying basis.